Hi, when I left off, we were rudely disconnected by the screencast-o-matic that said we had reached our time limit, but not to worry, we'll just go with video 2. This is noteworthy events and transactions. I think I had mentioned these all look pretty bad, but related transactions here, related party transactions are the most common. They occur when people are related to one another, either from a business standpoint or actually related like parents and children or brother and sister. Now, the problem with related party transactions is because the parties are intimately involved, that sometimes it's not hands length transaction, and that you may do something like give a better rate or choose them instead of a cheaper supplier because they're your friends and you know them. So there's a potential for things being misrepresented. So what usually happens is they just make sure that we say that they are related in some way for a related party transaction, and they'll discuss it in depth in the notes of the financial statements. I can't show you one on the Amazon financial statement because they don't have one, and not all of these occur for every financial statement. Which brings us to errors. Errors are non-intentional, as the screen says, and it just means that someone's made a mistake. So sometimes that happens in accounting, and just like everywhere else, you make an error and you find the error. And if the error is material and make a difference to a user's decision making, it should be disclosed. The second one there are irregularities. Irregularities are also like fraud. So fraud in any way, either upper management colluding to misrepresent the financial statements, or fraud where you might have two employees, say in the accounting department, working to steal and fraud from the company. Those should all be disclosed. And generally, irregularities should be disclosed, even if they're not very material. Just because when you find that you want to just make sure that everybody knows, so that later it doesn't come and blow up in your face. And you want to make sure that generally in those that you have closely said, what has happened and what they've done to change the practices to keep it from happening again. The last one is illegal acts. Obviously, fraud is an illegal act, but they're talking about something slightly different. Illegal acts are often things like bribes and kickbacks. In accounting, for illegal practices, we say that it is illegal to bribe public officials in other countries, but sometimes it does happen. You'd find out that it happens, so it should be disclosed. These disclosures can be quite sensitive, so you have to be careful. Obviously, errors, irregularities, illegal acts, they can be quite embarrassing for a company, but we also have to make sure that the need for users to have full disclosure is first. The privacy is second to the user's need to have full disclosure so that they can make appropriate accounting decisions. So that's noteworthy events and transactions. We'll go to the next slide. It talks about compensation of directors and executives. This is very important. Oftentimes, executives, top-level directors, make a great deal of money. If you are a shareholder or an investor, you kind of want to know just how much dough is being sent their way. Are they being responsible with shareholders' money, or are they putting it out the door to directors and executives? So what has happened is that the compensation of directors and executives are sent in proxy statements. Proxy statements are sent to shareholders every year. They're mailed to stockholders of records. And one of the things that'll be in there is the compensation of directors and executives, and also voting. So if you're voting that year for board of directors seats and that type of thing, or if there's a matter before the board, you want to make sure that you vote in the proxy statement. But that's where this compensation of directors and executives are. And you'll see that in the financial statements that they'll reference the proxy statement. They'll say that those disclosures are in there. One thing that makes it more difficult to understand how much a director, a top official, is paid is stock options. Stock options generally say, you can purchase stock at, let's say, $25. Sometimes it's at a discount of what it's trading that day. So if the stock is actually trading at $27 and they say you can buy it at $25, you can make a $2 bonus right off the top. So the company is helping and paying that extra $2 that you're not paying to get it off the market and get it in your hands. Generally, the stock options, though, you're going to have to wait a period of time. And that's to make a manager say, if I have the stock option and I make the company's shareholder value go up, then of course I'm going to be making more money for myself. So that influence, oops, that's not where I wanted to go. That influences executives and management to get good shareholder value. But they're difficult to value because if the stock is $25 today, we know that it could be as low as $5 tomorrow, or it could continue to rise, and that's what makes them valuable. Stock options can also be a bit tricky because sometimes it encourages managers to look at share price in a very short term till the end of their stock option expiration. But that information, stock options, is included in the proxy statement, and I'm going to take you quickly to a proxy statement. Look at it here. Let me move this over so you can see it. This is a proxy statement for Amazon.com, and you can say it's talking about compensation of named executive officers. So you can see Jeffrey Bezos, he's the chief executive officer. His salary was $81,840. That's not really a very high number, really, $81,840. But his all other compensation here was $1.7 million. Yes, that's the significant part for him. If you look at the number 2, it says it represents the approximate incremental cost of security arrangements for Mr. Bezos, in addition to security arrangements provided at business facilities for travel. If we take a look down here, you can see we have the CFO. They're making more than the CEO. There he is, $160,000. But you can see his total compensation is much lower. Last year, he was awarded $7 million in stock awards, though, so I think he'll be okay. But this is all in the proxy statement. And if you scroll down a little bit, they're going to give you some more information about their shares and their how they're getting money and when their stock vests, and that's all included in the proxy statement. Going back to the PowerPoint, we'll go to the next slide, talking about responsibilities. When we're looking at the financial statements, we should understand that management is responsible for the preparation of the financial statements, that there's the CFO and his accounting staff. They are responsible for the preparation of the financial statements and disclosures. The auditors absolutely do not write them, although generally most auditors have a format that they like their clients to use, and they do work in tandem together, but management is responsible for that preparation, and they'll type it all up. They are also responsible for accurately recording financial transactions and internal controls. So management is responsible for recording the day-to-day business transactions, and this includes everything from the accountant signing off on appropriate work to the recording at cash registers, making sure that those electronic transfers are happening appropriately and go through the system and end up in the accounting records appropriately. And also internal controls. Internal controls is new. You talk about SOX, the Sarbanes-Oxley Act, and that put a big emphasis on internal controls, SOX, there, and that put the management in charge of internal control and really highlighted their responsibility for internal control. And internal control really means that I have procedures in place where I'm safeguarding assets and I'm making sure that procedures are going to give me accurate results. So if managers are responsible for the preparation of the financial statements, they're responsible for the accuracy of their financial information, and they're responsible for internal control, what are auditors there to do? Well, auditors really are only there to be responsible for giving an opinion on the fairness and representations in the financial statements. In fact, if you go to an auditor report, that's what it's going to say. They're responsible making sure you're in adherence with GAAP, generally accepted accounting principles. So they're making sure that everything is in line with GAAP. They're not really testing for fraud. They're not looking for impropriety or irregularities. They're just making sure that things are in line with GAAP. Also, because of SOX, they now give an opinion on internal control. So they'll say whether or not they feel that you have an appropriate internal control and whether it is working effectively. Let's go ahead back to the Amazon annual report, although we couldn't do it for the noteworthy events and subsequent events. They weren't there. These are required in the notes of the financial statements, and they're in there. So we'll look at management's responsibility. And I need to go to page 76. So bear with me real quickly while I get to page 76. And here's management's report on internal control over financial reporting. It says management is responsible for establishing and maintaining adequate internal control over financial reporting. So there they are saying that they are responsible for that. And here they even mention the auditor. It says Ernst & Young has independently assessed the effectiveness of our internal control over financial reporting, and its report is below. So let's take a look at their report. This is an auditor's report. Ernst & Young is the auditor for Amazon, and they say they have audited Amazon's internal control over financial reporting, and they talk about conducting their audits in accordance with the public company oversight. And it says, in our opinion, Amazon.com has maintained in all material respects effective internal control. So they were giving them a clean report for internal control. If we look at the beginning of the financial statements, let me just get up there to that page. I can also show you their auditor report about the financial statements. So again, it says we have audited the accompanying consolidated balance sheets of Amazon.com and the related consolidated statements of operations, shareholders' equity, and cash flows. It says the financial statements are a responsibility of the company's management. Our responsibility is to express an opinion on these financial statements based on our audits. So they're quite clear that the financial statements belong to management. They express an opinion. So they'll say here, an audit includes examining on a test basis evidence supporting the amounts and disclosures in the financial statements. It says, in our opinion, the financial statements referred to above present fairly in all material respects the consolidated financial position of Amazon.com. So again, it is a clean opinion. Always this one, the report about the financial statements will be first and be followed by the financial statements, which come directly after it there. Going back to our PowerPoint, that's kind of it. We're done with this section. So I just want to thank you so much for your attention, especially switching to the two videos. This is my family enjoying Disney World as we did 3 years ago. As you're listening to this, we should be in Disney World, and when I return, I will make sure that we review any material. If you have any questions, we'll be certain to go over that. I want to make sure that you are participating in those forum discussions. Also, there are some YouTube videos. They're not done by me, but they're done by another gentleman. I've watched them. They're of good quality that talk about the ratios and doing financial analysis. I particularly like that he talks about what the numbers represent, because just knowing that you know, the quick ratio is 1.1 is not very helpful. You need to understand what those numbers represent. So please make sure you watch all the videos and participate in the forums. I will be available intermittently during this week. I'll be checking email, be checking in. So if you have any questions, please go ahead and send me that. But I'll be back and we'll be together and we'll review Chapter 3 and finish the financial statements. We'll actually create our own financial statements. And I look forward to seeing you back. Thanks very much.